In this video, I want to share the two most important aspects of portfolio risk, and more importantly, the best ways to guard against those risks. For those of you who are new to my channel, my name is Jared Ayers. I'm a CFA charter holder, and I've created this channel in order to share with anybody who wants to know the strategies and thought processes that I use to reduce my overall portfolio risk in my investments while maximizing the upside in my returns. In order to talk about risk, first we have to define what risk is. In my opinion, in order to define it, we have to understand what our objective of investing actually is. For me, my objective, number one objective, is not to lose. I want to have at least as much tomorrow as I do today. With that in mind, that helps me then define how I think of risk. So if my number one objective is not to lose, my definition of risk is basically the loss of capital, or having less tomorrow than I do today. So with that definition in mind, I then can move forward and determine how I can measure that risk, and of course how I can mitigate or protect against it. Before we can talk about measuring risk, I want to first touch on a couple of very popular definitions of risk that you may or may not have heard of. Volatility. That's something that we hear of all the time. Right now, in particular, in January 2019, the markets are quite volatile, or have been over the last several months. What we mean when we say volatile in that context is that the stock market in particular has gone down. So that is one aspect of volatility. The other aspect, the positive aspect of volatility, is a sharp rise in the value of assets or investments or whatever it is you're measuring. So when we say volatility, what we really mean in terms of risk is downside volatility or negative volatility. What we wouldn't necessarily see as a risk is the opposite of movement of that, or the increase or upside volatility in markets. So that's something that actually I think we want as much exposure to as possible while protecting the downside. Another popular way of looking at risk, especially with respect to returns, is that the higher the return, the higher the risk. This is something that is very popular among financial advisors, financial planners, and the industry as a whole when visually representing what the potential returns and risks are of any one investment. Now this is a common depiction of what the relative gain-loss scenarios are for a number of different model portfolios. This is often what you'll see from financial advisors and financial planners given to their clients. So portfolio A being the most conservative, long-term average return of 4%, positive or possible gain of 15%, possible loss of negative 10%. Portfolio B, obviously 25, negative 20, and portfolio C, 35 and negative 30, for a total long-term average return of 8%. Now, what that actually doesn't really tell you is obviously the mix of the investments within each portfolio. It just basically assumes that to get such high returns, you have to take on more risk. Now, what if somebody told me that, well, you could, in theory, get 35% upside with a mere 10% downside? I might be interested in that. But this doesn't really tell you, or even infer or pretend that that's even a possibility, which I sort of have a problem with, because I sort of think the opposite, and I want to show you why I think that in just a few minutes. Now, the two types of portfolio risk I want to talk about today are, one is called market or systematic risk. And this is the risk that you will lose capital due to an economic event that causes an entire asset class, or more than one asset class, to drastically and sharply decrease in value. The other type of risk is called unsystematic, and this is often called company-specific or security-specific risk, and this relates to an individual asset or security within an asset class decreasing in value. So those are the two types of risks that effectively you are exposed to in any portfolio, either the entire market coming down or one specific security in your portfolio coming down. Now, I want to talk about how we measure those two types of risk. How we measure market risk or systematic risk is really by measuring the economy. For me, I use a handful of market indicators, or economic indicators, that effectively are telling me what the economy is going to do. Now, we know that markets usually lead the economy, so it's not sufficient to understand what the economic indicators are actually doing at any point in time. What you need to be paying attention to, or what I pay attention to when I'm looking at those, is actually the rate of change. So, as an example, if the unemployment rate is falling, which is a good thing, but it's falling at a decreasing rate, in other words, it's starting to level off, that could be an indicator of something not so great that we're going to experience in the near future in the economy. If more than one indicator begins to perform in the same way, so like the unemployment rate that's declining, if it starts to level off, or in the opposite direction, if it's going up and starting to level off, if you're looking at an indicator like, say, GDP, what you're looking for is behavior that's similar across multiple indicators. When you begin to see that, that's then something that you really want to be paying attention to, because that's probably a sign that something in the economy is starting to change, and you want to be acting ahead of whatever the market's reaction to that change is going to be. If you wait until after the economy has already turned, it's too late. The market will have seen that and actually reacted before the economy changed, in which case you'll be in a market sell-off position effectively, and you will not have, or the time will have lapsed for you to actually have taken advantage of what those indicators were trying to tell you. In order to measure company-specific or that unsystematic risk, what I need to have is a fundamental understanding of the relationship between value and price. So if I know what companies' equities or bonds are worth, in other words, what the value of them are, then I can decide, based on the market price of that security, whether or not I should buy it. So again, if the price is significantly below the value, that actually is a less risky position for me to take. If the opposite is true, where the price is higher than the value, that obviously then means that I'm paying more than I think something is worth, which is not a very wise idea if indeed you're trying to protect yourself from a loss of capital. If you are paying far below the value, then you have what's known as margin of safety, a Buffett term, between the value and the price, and hopefully, not always guaranteed, but hopefully the risk of the price going significantly lower than what you paid for it is reduced. So that's the long and short of unsystematic risk measurement. Now I want to talk a little bit about how we then go ahead and mitigate or protect ourselves from both of those types of risks, or at least how I do it. The best way I know how to protect myself from market or systematic risk is to diversify my portfolio across asset classes. Now, how I define asset classes is actually very important in terms of risk management. I want to find asset classes that are as uncorrelated as possible. What I mean by that is, no matter what the economy is doing, I want to make sure that my asset classes are distinct enough that they perform differently depending on what the economy is actually doing. This gives me the best chance for diversifying my portfolio, again, in my experience. So that definition of asset classes, it becomes very important. As an example, some of the common terms for asset classes you may have heard: equities, bonds, cash, gold, commodities. Those are all quite distinct asset classes. Now, some other financial advisors, institutions, funds, mutual funds potentially, use more narrow, definitions of asset classes. So they'll say large cap equities are an asset class, as are mid cap equities, as are small cap equities. Each one of those, they say, is a distinct and separate asset class. Sometimes we'll talk about real estate as an asset class, but if the real estate is being purchased in the form of a REIT, a publicly traded security, effectively that REIT will likely behave the same way as the broader equity market. Similarly, if we talk about private equity, again, if it's a publicly traded private equity fund, it gets lumped in with all equities, regardless of whether the strategy is distinct and different from other publicly traded companies. To truly get the diversification, say, of a private equity fund, you really have to be high enough net worth individual to actually invest in a private equity fund. And that's something that we can talk about in another video. But the point is, you want asset, or at least I want asset classes that have the most separate and distinct behavior, no matter what the economy is doing. So I don't necessarily think more is better in that case. I think different is better. So once you have your definition of asset classes and you understand what the economy is doing because of the economic indicators, or at least the way I look at it is when I track economic indicators, I'm looking to see what the economy is doing. Then I have my asset class definitions. So at that point I can decide, well, if the economy is about to take a downturn, I want to be recalibrating my portfolio into those asset classes that are going to perform best in, say, an environment where the economy is getting worse. So when I use the term recalibrate, I'm doing that intentionally as opposed to the term rebalance. Rebalance, I find, is often used to describe a reversion to some sort of mean distribution across different asset classes. So let's say you had 4 asset classes and you decided that I'm going to hold 25% in each of those 4 asset classes. Then periodically you are rebalancing, or maybe one of those asset classes goes up to 30%, another one of those goes down to 20%, and so on. And then at some point, maybe determined by the calendar, or maybe determined by thresholds around those 25% norms, you rebalance that portfolio back to 25% across all asset classes. Now, in order to manage against unsystematic risk, or the security or company-specific risk I spoke about previously, the best way to protect yourself within any asset class, again we're kind of talking about assets within an asset class, is to diversify or have more than one, or a very small amount of securities in that asset class, so that you reduce your risk of exposure. Now, let's just talk about that for just a second. I am somebody who can and does constantly review companies and look at opportunities to buy stocks in my equity portfolio. I have a very good idea of price versus value. I know what I'm looking for when I'm looking for companies, and I have a very good track record of identifying winners. So for me, one of the things I think about is how much diversification do I need to get the benefit of diversification. So therefore, one of the most common beliefs of diversification is more is better, right? However, if you look at the actual statistics, Just a portfolio of 8 stocks actually reduces your unsystematic or company-specific risk by over 80%. So already you're at the 80-20 rule. At 16 stocks, you're over 90%. At 32, you're over 95%. At 500, you're at 99%. So at a certain point, every incremental stock gives you a lower benefit in terms of the diversification. So many of you will know that as diminishing returns. For someone like me who can pick winners and who can rank sort of in order of probability which ones are going to perform the best, every incremental stock I add to my portfolio, there's actually kind of a two-sided loss. In one instance, there's diminishing returns and there's a diversification benefit, and also I'm adding a less and less favorable security to my portfolio every time I'm adding one more stock to it. The other side of that is, of course, because I am a stock picker, I look at my portfolio, I look at all the companies that I invest in, and I track and follow them. The bigger my portfolio, the tougher that is. So the more stocks I hold, the less, or the further I am from them. So the more difficult it is to monitor them. So for me, that also can hurt my returns. If something happens to one of my portfolio companies, I want to be able to react right away, whether that's positive or negative. If I have too many to follow and I'm not close enough to the company to know when things happen that I need to know about, then I'm kind of out of luck, or at least I'm not going to be performing optimally. So that's the other reason why, for me, diversification is definitely the way to go, but only so far. In other words, I don't want to be diversified beyond what's actually manageable for me. So just to recap, we talked about 2 types of overall portfolio risk: market risk or systematic risk, and unsystematic risk or company or security specific risk. We talked about how I like to measure those, some maybe non-common ways or views of thinking about how I measure those, and then of course how to manage them. So using basically the measurement criteria as a jump-off point for how to manage the risk exposure of those 2 types of portfolio risk. So I'd love to hear your feedback, I'd love to hear your questions. Go ahead and enter any questions you have in the comments. Like the video, hit the subscribe button if you wish, and I hope to bring more value as I continue on this journey. Thank you very much.